You know that feeling. Wanting to get a real handle on how a company's doing, but without wading through pages and pages of dense financial reports.
Yeah, it can be pretty overwhelming.
Well, today we're aiming to do the heavy lifting for you. We've gone deep into Angel One's latest earnings call transcript. This one's for Q4 of their financial year 2025.
And these transcripts, they're really insightful, aren't they? It's basically the company's leadership talking directly to analysts.
Exactly. It's raw conversation about performance, strategy, where they see things going. A direct line, really.
Right? Unvarnished, you could say. It cuts through a lot of the usual corporate speak sometimes.
Right. So our mission today is pretty straightforward. Pull out the most important insights from this call. We want to look at, how their different business parts are performing.
The different segments.
What the leadership thinks about the industry right now, their plans, and crucially, what challenges or risks they're flagging.
And it's useful that we hear from quite a few people on these calls, right? The chairman, CEO, CFO gives you a broader perspective.
Definitely. You get the full leadership team's view. So shall we dive straight in? Maybe start with how the core business segments are looking.
Sounds good. The transcript definitely showed some interesting shifts happening, particularly in their main broking division.
Okay, yeah, let's unpack that broking side first. It seems like those new F&O regulations were, well, kind of the elephant in the room.
Absolutely. They reported a pretty significant drop in order volume because of it. Down, what was it, over 22% from the previous quarter?
Yeah, 22.4% sequentially, landing at 327 million orders. That's a big dip. And it naturally means fewer active clients, less activity overall.
And that drop in activity hits the bottom line directly. Their total income, the gross revenue, and their net revenue from broking were both down, around 16% sequentially.
Drilling down even more, that gross income just from brokerage fees fell quite a bit to over 22%, down to $6.3 billion.
Right. And it shifted the mix of where that brokerage revenue came from.
That's what I found interesting, too. F&O is still the biggest piece, obviously, but its share dropped to 77%.
And cash trading actually picked up some slack.
Yeah. Cash went up to 14% contribution, and commodities ticked up a bit, too, to nearly 9%. It suggests maybe a shift in trader behavior, perhaps.
Could be. Or just a reaction to the new rules making F&O a bit less attractive for some, maybe. Something to watch, definitely.
For sure. Another point they made was that their direct business clients coming straight to their platform, they've stayed really strong, still making up 76% of their net broking revenue.
That's important. Shows the strength of their brand and platform, retaining those direct clients even with market shifts.
And talking about stability, the average client funding book the money clients keep with them for trading, that held pretty steady, around $40.3 billion.
But the income from that, the interest income, dipped slightly.
It did, yeah. They mentioned it was because they lowered the interest rate on their margin trading facility, the MTF.
Yeah.
Dropped it to just under 15%.
Ah, okay. So that's a balancing act, isn't it? Lower rate might encourage more borrowing, maybe attract clients, but earns them less interest per loan.
Precisely. It's a strategic lever they can pull.
But it wasn't all declines. There are other income streams, the distribution side, things like selling credit products, insurance that actually grew.
Oh, right. The distribution operations, up almost 5% sequentially.
Yeah, 4.6%, hitting $314 million. It's still a small slice of the overall pie, about 3% of total gross revenue, but it shows that diversification is, starting to contribute positively.
Okay, so let's dig into that distribution side a bit more then, starting with credit. Sounds like demand there was pretty robust.
Very much so. They mentioned disbursing over $7 billion in unsecured loans cumulatively by the end of March 2025. That's quite a number.
And it's not just the volume, is it? It's how they're approaching it, expanding partnerships.
Exactly. They're up to 6 lenders now, a mix of banks and a fintech partner. But what's maybe more interesting long term is they're building their own tech for it.
Like that lender allocation engine they mentioned. And using AI for risk.
Yeah, proprietary stuff. That could really give them an edge in efficiency and risk management down the line. Building their own models.
They did flag a bit of a slowdown in Q4, though, didn't they? In credit disbursement. Said they were being more cautious with underwriting.
Which makes sense, right? Given sort of general economic uncertainty, a bit of caution in lending isn't surprising. Probably wise.
Okay, so that's credit. What about mutual funds? The transcript mentioned a bit of softness in new SAPs.
Yeah, new systematic investment plans were around 1.9 million, so maybe fewer brand new investors starting regular plans in that quarter.
But the overall picture wasn't necessarily negative.
No, because their total assets under management, the AUM in mutual funds, kept growing, and their share of all new SAPs across the industry held steady. So existing clients seemed to be sticking with it, even if attracting totally new ones was a bit tougher.
And they mentioned running their first big brand campaign specifically for mutual funds.
Targeting new investors, trying to position themselves as a really user-friendly platform for people just starting out with MFs.
Makes sense. Okay, third part of distribution, insurance. Sounds like expansion was the theme there.
Yeah, they brought 2 more insurers onto their platform, more choice for customers.
And the focus seems to be on the user experience, using tech.
Definitely. They talked about best-in-class journeys, using AI for personalization, offering both digital and assisted options, trying to make buying insurance smoother.
So clearly building out those non-broking businesses. Now, the next big step seems to be their asset management company, the AMC. Actually managing money themselves, that feels significant.
It really does. A major strategic move. They launched their first funds, NFOs, new fund offers, focused on passive investing initially.
Right, the Nifty Total Market Index Fund and the ETF, tracking the same index. India's first for that ETF, they said.
Correct. And they quickly followed that up with a debt offering to another ETF, a liquid one focused on daily rates. So hitting the ground running.
Has it gained any traction yet? Early days, I suppose.
Seems like it. They reported $740 million in AUM across just those 3 products already. And maybe more importantly, they highlighted participation from clients across over 8,800 different PIN codes.
Wow, that suggests pretty wide geographical reach right off the bat. Okay, and the last piece is their wealth management arm, Ionic Wealth. What's the focus there?
For this year, the big theme seemed to be asset allocation, guiding clients, especially wealthier ones, to diversify beyond just equities.
Into things like gold, debt, global stocks.
Exactly. Precious metals, debt, international equities, really pushing that diversification message, which again makes sense in the current volatile climate. They also talked about the huge potential market in India for wealth management.
Yeah, they threw out a big number, potential growth to, over $1 trillion US?
Something like that, yeah. USD 1 to 1.2 trillion. A massive opportunity they're trying to tap into.
And how are they doing that? What's the model for Ionic?
It sounds like an omni-channel approach. They have a direct-to-consumer app, but also offer personalized portfolio management for the ultra-high net worth clients.
And have they seen results in their first year?
Pretty impressive ones, actually. Over 3,790 crores in assets under management or custody in just the first year since inception.
Wow. And most of that is actively managed.
Yeah. The bulk of it, about 3,327 crores, is actively managed AUM. The rest is custody. And they noted that roughly 3/4 of that AUM is recurring.
That's key, isn't it? Recurring revenue suggests stickier clients, longer-term relationships.
Definitely points towards building a sustainable wealth business.
Okay, so that paints a pretty detailed picture of the individual business segments. Let's zoom out a bit now. What did the management say about the broader industry and their overall strategy to navigate it?
Well, they definitely acknowledge the current environment is challenging. They use the phrase transformative phase, I think, pointing to those F&O rule headwinds and, the general geopolitical volatility.
Right, factors impacting everyone. But their take on the F&O rules was interesting, wasn't it? They didn't seem entirely negative long-term.
No, quite the opposite, actually. Despite the short-term pain, the volume drop, they seem to believe it's fundamentally constructive for the long run.
Constructive how?
They think it'll lead to more predictable unit economics, like a clearer picture of customer lifetime value, LTVs, sort of recalibration, they called it.
Interesting. So, see past the immediate disruption. And they're still investing for growth despite that, even if it hits profits short term.
That was a clear message. Commitment to long-term growth investments remains strong, even if it means near-term profitability takes a bit of a hit. They see it as necessary to build that bigger financial services platform.
And they did point to some underlying positive signs in the market, didn't they?
Yeah, things like healthy DIM account opening numbers continuing, retail participation still being strong overall, and good demand for mutual funds. So the underlying appetite for investing seems intact.
So the long-term strategy is really about moving beyond just being a broker.
Absolutely. Building that comprehensive platform. Credit, insurance, fixed income, wealth, AMC, covering the whole spectrum.
And tech is central to that vision.
Hugely central. Big investments mentioned in advanced analytics, AI, ML. The goal seems to be using tech to personalize everything, the client journey, risk assessment, product recommendations, making things more relevant.
They also mentioned tweaking their partner strategy in the assisted offline business.
Yeah, refining it, focusing more on the quality of partners and hyper-local engagement rather than just sheer numbers, a more targeted approach, maybe.
And underpinning it all is that digital-first model, believing that's the key to scaling efficiently and boosting that customer lifetime value.
Right. And speaking of strategy, the new leadership appointments also seem significant.
Oh, yeah. And Barish Kanjo, as Group CEO, coming from a strong tech background, and Chief Data Officer, Rohit Chatter.
Exactly. Signals a real doubling down on technology, AI, and data as core drivers for the future.
And the ultimate goal of all this diversification and tech, get more business from each existing client.
That seems to be the idea. Increase the wallet share, become the main financial hub for their customers, offering everything they need.
Okay, so that's the strategy. What about the outlook? How do they see the next year or so playing out?
Well, they were pretty upfront that they expect client activity might stay a bit subdued through the first half of the next financial year, FY26.
Still feeling the effects of those F&O changes, presumably?
That seems to be the main factor, yeah. A period of adjustment.
But they do expect a recovery.
Yes. They're forecasting a return to, let's say, normal activity levels with operational metrics and profitability getting back towards previous levels by the end of FY26. So Q4 FY26 is the key time frame they mentioned.
That's a specific target. And plans for the newer businesses, like the AMC.
Ambitious plans there. Expanding the product range, especially in passive investing, seems like they really want to build out that side of the business.
And Ionic Wealth, the wealth management arm.
The long-term vision there is positioning it right at the heart of India's wealth creation story. They see it as a major strategic pillar for the future.
What about the financials? Did they give any guidance on margins?
They did. They expect their core profitability metric, the EBITDA margin, to get back into that 40-45% range by the exit of Q4 FY26.
Back to previous healthy levels.
And potentially expanding further in the following year. So confidence in the underlying profitability returning as things normalize, and the new businesses contribute more.
And those new businesses, like credit and insurance distribution, they see continued long-term growth potential there.
Absolutely. Still relatively early days for those, so plenty of runway for growth is the expectation.
Okay, so that covers the positive outlook and strategy. But we also need to talk about the risks and challenges they acknowledge. It wasn't all smooth sailing.
No, definitely not. And they were quite open about the immediate pain points. The F&O regulation impact was front and center, causing that volume decline right away.
That's the big one, short term. And the softer market conditions generally. Geopolitics.
Yeah, they cited those as current headwinds, too. Creates uncertainty, affects investor sentiment. These are broader factors, obviously.
And these directly led to the weaker financial results in Q4 FY25, right? The sequential declines we talked about earlier.
Correct. Revenue, activity, profits all took a step back in that quarter due to these combined pressures.
They also mentioned higher operating expenses in Q4. Something about the IPL.
Ah, yes. Increased other operating expenses, partly due to their sponsorship of the Indian Premier League cricket tournament and related marketing spending. An investment in brand visibility, but it adds to costs.
And their overall profitability metric, return on equity or ROE, that came down.
It did. Contracted to 27% for FY25. Still a decent number in absolute terms, but lower than previous years. They attributed that directly to the regulatory changes and the market softness.
We also touched on the temporary slowdown in credit disbursement due to that cautious underwriting. That's another challenge, balancing growth and risk.
Exactly. A necessary caution, perhaps, but still a factor impacting growth in that segment for now.
And one last thing they mentioned, I think, was about client activation rates.
Yeah, this was interesting. The rate at which new clients actually start trading after joining has apparently been declining over the past few years.
So they're still growing the client base overall, but maybe fewer of the very new ones are immediately active.
That seems to be the gist. Management emphasized the importance of base growth itself, but yeah, a lower activation rate is something they'll need to monitor or address as it could affect future revenue.
Okay, so let's try and wrap this up. We've covered a lot of ground from that Angel One earnings call.
We have. It really painted a picture of a company navigating some pretty significant changes, hasn't it? Both regulatory and market-driven.
Definitely. The core broking business clearly took a hit from the F&O rules, no doubt about it. But their strategic response seems clear. Double down on diversification.
Yeah, push hard into credit, insurance, asset management, wealth management, build that broader financial services ecosystem.
And lean heavily on technology to make it all work. Personalize it, make it efficient.
Right. And they're projecting a recovery, anticipating things getting back to a more normal state, profitability-wise, by the end of the next financial year, Q4 FY26.
So despite the current choppy waters and the risks they acknowledged, the leadership sounds, well, still pretty optimistic about the long game, focused on building long-term value through this diversified model.
That was the overriding message I felt. Confidence in the long-term strategy.
So this whole deep dive leaves us, and you listening, with something to think about, perhaps.
Yeah, it really highlights how major shifts like regulatory changes or global economic volatility aren't just short-term disruptions, are they?
No, they can also force companies to adapt, innovate, and potentially create new long-term opportunities.
So the question for you is, how do these external pressures shape the evolution of companies in financial services? And maybe how critical is that agility, that diversification we saw Angel One pursuing for thriving in such a constantly changing landscape?
It's definitely worth considering. And of course, if you want the full granular detail, delving into the complete earnings call transcript yourself is always a great next step.